Here in Los Angeles, we have global business executive Ryan Patel and financial commentator Alan Haft also standing by. But Malika, first to you, it seems the markets in Asia, what the Trump surge giveth, the Trump plummet taketh away. That's hard to say.
Well, yes, I mean, but as you pointed out just a few seconds ago, you know, the markets are still up since the time Trump came to power. So it's, and earlier on, just on CNN, a few hours ago, we did have a financial analyst talk and say that, you know, he has taken so much credit for the economy being in great shape, for the stock market booming, for one rally after another. So he's also got to take some sort of responsibility for what's happening with the stock market now. But having said all that, politics aside, this is really a story about interest rates. There is concern about stronger economic data. We had those wage employment numbers come out in the U.S. on Friday. There were strong numbers. That's good news for workers. But, of course, that translates into fears of inflation, which then means that central banks, the U.S., will be forced to raise interest rates more than it had thought to. This will lead to interest rates around the world going up. And that's really what's happening, what's putting pressure on stock markets around the world. This is very much a story about interest rates. What analysts are also saying, this is also, you know, the time was ripe for a bit of a pullback. This is a correction. It's not a collapse, and there's no need to panic just yet.
Thanks, Malika. Hey, Alan, to you, here's a good global assessment, which we have in the New York Times. It reads, the world's largest economies are all expanding as the most important central bank, the United States Federal Reserve, is draining billions of dollars from the financial system and raising interest rates. And investors are concerned that tenuous signs of inflation could mean central banks around the world will start to remove their support even faster. In other words, the era of low interest rates is coming to an end, if it's not over already. And every time there's been a hint that someone would take the punch bowl away from the party, markets have gone into a spin. Is that kind of what we're seeing now?
It's exactly what we're seeing right now. And over the last 9 years, since the market's been generally on an upward trajectory, there's been a couple spotty times where we've heard this story before. And I'm not trying to downplay it, because I think this time it does have some validity, especially since since unemployment is at a historical low. And a couple other indicators are showing that inflation and the Fed will likely start to raise interest rates. It's a question of how fast. But in the few spotty times we've seen this in the last 9 years, there's been momentary panic. Calmer heads prevailed a few days into the panic, and then we've seen some nice rebounds. So I wouldn't exactly panic yet, and I don't think the panic that we're seeing out there over the last few days is warranted nearly as much as it is. Hopefully it'll taper off and calmer heads will prevail, and people start to realize that this isn't going to happen overnight, and it's just a little bit of a wait and see right now.
Malika, just quickly back to you. If we're talking... Oh, we've lost Malika. Okay, no problem. We'll go over to Ryan, because, Ryan, you're a conservative commentator and #1 Trump supporter, Sean Hannity. He's taken this one step further, and he managed to blame this stock fall on President Obama.
Because the Obama economy was so weak all of these years, we had just artificially cheap money. Now, what's cheap money? Cheap money is when you can borrow at ridiculously low rates. The era of cheap money at some point has to come to an end.
You're right. That assessment isn't entirely inaccurate. I mean, we're seeing that play out. But what about, the fact that, it was all Obama's fault for having a weak economy?
Well, I'm laughing that he said that. I mean, the fact that all last year, you had this great market. We didn't even face any kind of resistance, and there's going to be taken credit by the administration. And then as of today, in the last, all the gains have gone throughout since January, and not one beep from the White House. You're right. He said that, to get out of recession, they had to go down to lower interest rates. And it is known that interest rates are going to have to rise. But you can't blame the Obama administration for this. I mean, obviously, you got December with high jobs. You got more people investing in the market as of January because of what was going on last year. So, again, you're going to blame all that on the past administration. It doesn't make any sense to me, but, I think it's just trying to deflect on what's going on.
Okay, there has been this expectation of a stock market correction for a very long time. If there is a data point, for now it seems it was that jobs report last week, which showed very strong wages growth in the US. So Ryan, I guess once again that proves what's good for the economy isn't always good for the markets.
Yeah, I mean, I think where investors got worried is when you have the job market going up, wages increasing as well, and investors are going to see, hey, you know, that kind of leads to this inflation. And with this inflation, then comes the worries of these investors going, okay, it's going to cost us a little bit more. So, yeah, good things don't always have to come in. We were waiting for this pullback, and again, people are kind of shocked because we didn't get it last year. We were kind of spoiled and not having any kind of resistance, like I said.
And Alan, we've heard repeatedly Donald Trump, talking about record high closes, on the Dow, on Wall Street. At one point, saying it would actually even reduce the national debt. I think. How much of an impact has that actually had on this stock market rally?
I think a smart investor is going to ignore all the white noise. I think just look forward. It's a great time to reassess your portfolio. If you had a lot of panic over the last couple of days, it's a great time to reassess what you're in and how long of a time horizon you have. So my advice would be just take into account all different factors, but generally speaking, fly over the radar of all the white noise out there, especially coming from Donald Trump. And I'm not trying to say I'm trying to stay objective in it, because when it comes to money, you should just really look at your own situation and try to assess what the best path is for you and for how long you're going to be investing before you need to start pulling money out. And during these times, it's absolutely the best time to be doing that.
Okay, finally, Brian, to you. The U.S. government is expected to borrow close to $1 trillion this year, more than $1 trillion in the years which follow. The conventional wisdom has always been governments should run big deficits during a recession to stimulate growth. The U.S. economy is far away from recession, and the Trump tax cuts of $1.5 trillion, and there's another maybe $1.5 trillion in infrastructure expenditure. Is that pouring gasoline on an already raging fire?
Yeah, and if you take in consideration that there isn't any kind of agreement with the debt ceiling between both parties to even voting on, right? They need 60 votes from the Republican Democrat Party, and they're not nowhere near close. This is a situation where you don't want to get to a government shutdown in the midst of this, potentially sell-off.
Yeah, we also have the situation that overheating the economy leads to greater inflation, which then leads to higher interest rates, and it's a vicious cycle which we would like to avoid. Alan, Ryan, good to see you both. Thank you.
Thank you.
Thanks for having me.